Right, okay, so I'm nervous about making this video. I'm a financial advisor talking about cryptocurrency, of course I'm nervous. But really should I be, and is it right for me not to address this topic? Anyway, look, if you haven't been living under a rock, you might have noticed all of this.
Bitcoin, what's the price right now?
Can anything slow down the surge we have seen in Bitcoin?
People are going to realize that there is a better currency. They'll start.
So before I begin, as I'm talking crypto, my tedious little risk warning might seem a bit, well, gonna need a bigger risk warning. So just remember, anything crypto right now is the Wild West of finance, with scams rife, completely unregulated. There is so much there, there'll probably be a ton of horrific WhatsApp crypto bots on this video at some point. So just remember, if you see any of them, it's not me, buyers beware, times 1,000. Anyway, look, I think pretty much everyone watching this will know what Bitcoin is, but just for a brief summary. Formed in the aftermath of the banking crisis in 2008, the famous white paper from the mysterious Satoshi Nakamoto, Bitcoin, a peer-to-peer electronic cash system. Right, the problem that Bitcoin was trying to solve, it was part technological advance and part independent finance movement. This introduced what would almost certainly be a world-changing technology, which is blockchain. So how a blockchain works is kind of very simply like this. It solves the problem of how can we quickly know what is reliable and true. Bitcoin is kind of the first iteration of this technology, designed to be a decentralized currency. Now, just before all the Bitcoin bros start saying, it's just a store of value, bro. Just remember that the paper was called a peer-to-peer electronic cash system. So anyway, it was designed as a currency, didn't require banks. So instead of a transaction looking like this, which is sort of what a central network looks like, it would look a little bit like this. Does that make sense? And how it does this securely is by a series of technological steps kind of governed by quite a clever incentive structure and cryptography. But this episode isn't a deep dive into how Bitcoin works. The rest of the story, from its sensational rise from May 2010, someone buying a pizza with 10,000 Bitcoin, to 1 Bitcoin being worth roughly at time recording about £26,500. The narrative behind this has also shifted a bit, and most regard Bitcoin as an alternative store of value, like digital gold, more than an alternative currency to buy normal goods and services with. So in today's video, I'm going to be talking about the ideas behind a bubble or an anti-bubble. These concepts were put forward by Diego Perella. So a bubble is artificially expensive assets, and there have been a ton of examples from the tulip mania, the South Sea Company, the Japan stock market to the dot-com bubble, all driven by a false belief based on a misconception. This is kind of like the financial equivalent of the emperor has no clothes, and the asset will collapse. It's a matter of when, not if. So the idea behind an anti-bubble is kind of like the mirror opposite, and this is artificially cheap assets, also driven by misconception, something that the market doesn't quite understand. The anti-bubble actually offers extreme value because the market doesn't fully understand it yet. So it's really important that in this video and in this concept, in both instances, what drives the heart of the issue is a misconception. So I think the purpose of this video is to openly discuss where is the misconception. And I'm going to try and do everything I can to give a balanced view. But remember, this will still just be my view, and agreeing or disagreeing is okay. I think I can almost hear the comments from here.
We're not selling! We're not selling! Elon!
Anyway, look, the purpose of this video isn't for you to think like me, it's just to think. So let's go over the case for the anti-bubble. And this is basically that Bitcoin offers extreme value, but the market just doesn't understand it yet. And to look into this, we kind of need to understand what problem Bitcoin was designed to solve. If you think about it, our banking system is inefficient and arguably quite unfair. There are a huge amount of people who actually don't even have access to a bank account. It was stated about 1.7 billion in 2017. And it's kind of effectively another way of enforcing poverty on the unbanked. In addition to this, despite apps making things look a bit more flashy, the underlying plumbing of our banking system is pretty archaic. And depending where you are in the world, transactions between banks can sometimes take an age to process. as well as issues with international transfer fees. So Nakamoto's concept was to decentralize a distributed database, which would come to drive this mediation from a distinct... I'm sorry, I just got carried away. Because Bitcoin offers quite a low-cost, quick payment settlement. On the 12th of April 2020, someone transferred 161,500 Bitcoin. That's worth about $1.1 billion at the time in a single transaction. The transaction settled in 10 minutes, and the fee for processing this transaction was apparently about 68 cents. Contrast that with international money transfer fees, which can take many days, have substantial fees. You really get an idea for the difference here. But the case, however, for the anti-bubble is kind of in a world where digital assets are becoming real assets. Bitcoin offers an alternative store of value, and Bitcoin is designed to be a scarce digital asset with only 21 million Bitcoins that can be mined. No, not mined in that way, in a different way, basically solving digital puzzles to maintain the network. Bitcoin has also, without a doubt, shrugged off the initial naysayers who wrote it off. Having been around now for over a decade, it's becoming more and more ingrained not only in public consciousness, but also in financial institutions. There are institutional investors promoting Bitcoin, as well as financial institutions getting involved in different levels. JP Morgan reportedly are going to let clients invest in Bitcoin fund for the first time. The overall case here with the anti-bubble, it's a revolutionary technology and it will grow in value the more that it is adopted. This is also being faced with comparisons where central banks around the world are using loose monetary policy, basically fixing interest rates next to zero. The misconception here, and the case for Bitcoin being the anti-bubble, is that we're interpreting Bitcoin as a fad, when actually it's a new asset, a store of value in an ever-increasing digital world. One which is already proven to have a degree of staying power and provide an alternative store of value in a world of, well, return-free risk. So where's the misconception here? So the case for Bitcoin is that it's a solution to loose monetary policy, central banking, and inflated asset prices. Like, those issues are pretty much undeniable, independent of Bitcoin. The question is this just a case of us making a mental shortcut in our brain and basically picking a simple solution when it's actually much broader than the initial argument would imply? So the case for the bubble is effectively deconstructing the narrative that Bitcoin is the solution to those problems. And to do that and try and explain why Bitcoin may be a bubble, I need to talk about Executive Order 6102. And look, I know what you're thinking. It sounds a little bit like...
Judge was given Memo 618.
Memo 618.
Well, that's kind of because it is. On the 5th of April 1933, the US President Franklin D. Roosevelt forbid the hoarding of gold coin, gold bullion, and gold certificates within continental United States. This was in part a reaction to the crippling effects of the Great Depression. The American government required all Americans to forfeit their gold above a very small amount, yet give it up to the government. If you haven't guessed this already, the comparison that I'm drawing here is simple. A government threatened on a social and political basis and on their monetary system, because remember, at that time, there was a gold standard. Gold effectively was directly linked to money. I would say never underestimate a government's ability and willingness to defend themselves. Look, it's not just me that's aware of this. Listen to Ray Dalio.
I think Bitcoin's greatest risk is its success. Right now, it's not such a big deal. Fighting it is more of a big deal. As it becomes a bigger deal and more of a threat, let's say people want to sell their bonds and they want to buy Bitcoin. And that's an existential risk.
The point I'm kind of trying to make about this is that there is enormous power with having control of a currency. But the dichotomy here is that the strength in decentralization and what makes that successful could plant the seeds for what stands in the way of its growth. Basically, government intervention, or just being a victim of its own success. A lot of central banks are also now looking at their own cryptocurrencies. So they're going to be very unwilling, I think we can both agree, to have two parallel monetary systems which truly compete, as it clearly threatens their power. What we know about Bitcoin as far as decentralization, and yes, you might know where I'm going with this, it's also made it a perfect candidate for money laundering, trafficking, terrorism.
First, let me assure you that this is not one of those shady pyramid schemes you've been hearing about. No, sir. Our model is the trapezoid.
All these sort of things which you have to argue, even as a Bitcoin fan, would make it a target for government intervention, whether that be for more stringent taxes or basically just outlawing it entirely. Whether you agree or disagree with whether that's true, you can't deny it is a very convenient excuse. There's also a big debate about how decentralized currencies work in a way that the financial system would openly adopt. For example, look, if you come to any advisor or any financial institution to invest a large sum of money, there has to be money laundering checks. We have to know where the funds have come from so that they aren't being used as part of drugs, trafficking, etc. It's a legal requirement in most developed economies. You can't just have freewheeling money transfers everywhere. This inevitably will be an issue that DeFi or decentralized finance has to get over if it does truly want to become ingrained in the financial system. That doesn't mean that it's an insurmountable issue, but it is just a key barrier to entry that you have to be aware of if you truly think it's going to take over the world. If you don't think this risk is real, all you need to do is look at the recent episode with GameStop and the Robinhood trading platform, where the rules of our financial system, the game, was changed in the middle of a short squeeze. And you might be thinking, well, that can't happen, it's impossible, they can't stop me owning cryptocurrency, the government doesn't have the power, they can't control the assets of the internet. But come on, you say that having not left the house for the best part of last year because of the instruction of... All right, okay, I'll turn down the sass a little bit, but I think it's still something that's worth bearing in mind. Okay, so the next point is about the reality of a technological revolution. And if you do believe blockchain is a technological revolution in itself, which, I do, I need to introduce you to Carlota Perez. She wrote the book, Technological Revolutions and Finance Capital. She has studied various technological revolutions, and she's found that all these technologies have roughly the same pattern, be it the Industrial Revolution, the Age of Steel, the Age of Automobiles. So each technological revolution begins with a huge experiment with higher rewards that ends with a financial bubble. So the point I'm making here is quite simple but intuitive. A new technology gets people excited. And what do people do? They get overexcited. So does blockchain look like it's a bubble? Well, there's a famous story, which we don't actually know if it's true. In 1929, a shoeshine boy gave Joe Kennedy stock tip. And Kennedy, being a wise old investor, thought, if the shoeshine boy is giving stock tips, then it's time to get out of the market. For me, this is exactly how it feels right now about cryptocurrency. People who have no interest in finance are talking about Bitcoin because the neighbor down the road has made some money. Now, that doesn't obviously make it a good investment. By definition, people make a lot of money in bubbles. In the paper, A New Wolf in Town, Pump and Dump Manipulation in the Cryptocurrency Markets, they found that there is huge manipulation in cryptocurrency markets. Were we surprised? No. And they said, if left unchecked, widespread manipulation in cryptocurrency markets can lead to a loss in confidence in those markets and the technology of tokenization more broadly. Even if you do believe blockchain's potential, it is extremely hard to unpick who will be the future winners in this technology. How do you know that you've backed Facebook, not MySpace? Or how about Google, not Ask Jeeves? How, without foresight, do you know who will be the future winners? And it speaks to the heart of any emerging technology. If there are various iterations of technology going forward, government coins, competition, are we not looking at it from a lens which is a bit historically inaccurate, that we're confusing an exciting technology? Listen to this.
Faster that we can shift from this fantasy that it is going to make you rich in a sort of 1920s tulip bubble kind of way, is the sooner that we can get into people, honestly, and I mean this like with all the hope in the world, people being disappointed in blockchain. It's like, oh, I didn't get rich. It's just being used now to make it easier to transact goods and services safely across borders.
Okay, so I hope that's given us some things to think about. And so let's have some final thoughts. Why should anyone care and why should I care? At the end of the day, this is an educational channel. I'm not in charge of your money. I'm certainly not here to tell you what to do with your money. But hopefully kind of those of you who follow me will know by now. I do feel strongly that there is a massive gap in financial education in this country. And my biggest concern around cryptocurrency mania is that there are many people who truly believe that they should probably put everything into this, spurned on by Bitcoin bros, meme culture, and let's be honest, quite a toxic culture around Bitcoin sometimes. Bitcoin isn't just a cryptocurrency for some. It's kind of a statement against big banks, big institutions. So there's more to HODL than just quick cash. Although, let's be honest, that's probably the driver for most. The truth is, nobody actually knows how this is going to pan out. And in the episode of Making Better Decisions, I talked about how it's important to be humble with both sides. My thoughts are, personally, I think about an 80% probability that Bitcoin is a bubble, and there's about a 20% probability that it's an anti-bubble. I think the reality is that when you look not only at history through technological revolutions, through potential for risks in relation to government intervention, and also just, for example, when you look at any company who has succeeded in an emerging technological space, the probability for the first mover to be the company that sustains long term, to deliver the kind of exponential value that some Bitcoin holders are expecting, is extremely low. This is just my opinion though, and I might be wrong. My biggest concern right now is what we're seeing in the cryptocurrency space is actually very predictable human behavior. And I guess the thing that I'm thinking is that when you look closely, it's quite likely that this might not be a technology story, but a psychology one. And with that, there's probably only one more thing to say.
Have fun staying poor.